This is Prem. Welcome to the More Trading, More Earning program. In this video, we are going to learn about a new strategy called Big Buy Covered Call Option Strategy. So, why we look for option strategy? It is mainly because for a option seller, when you do a NACT call or a NACT put, sometimes if the stock moves violently or if the market moves violently to the direction which is anticipated by the option traders, then they will incur a huge loss. To avoid such huge losses, option traders go for some option strategies. This is one such option strategy. So the option strategy name is Big Buy Covered Call Option Strategy. For easy learning, I want to split this into 2 points. One first part is the cash trade. Second part is the future long call option sell trade. So we will explain this one by one, and this is mainly for learning purpose. For trading, how to do your own analysis, then decide how to go about it. So first is the cash trade. So cash trade, everybody know what is a cash trade. So you have cash in your account, then you buy a stock and retain it for a few days. When you feel it's profitable, then you sell it and get the cash back. Or you have a stock and you want to sell it in the market at the appropriate time, and you sell it and you receive a cash. So this is what we say it as cash trade. So the part one is cash trade. So in a cash trade, so you decide a stock for this big buy covered call option. So how to decide a stock? So you cannot buy any stock that you want to buy when you go for a strategies like big buy covered call option strategy. So my choice is you select one of the nifty stock, top 10 nifty stock where the market capitalization is huge, maybe like HDFC Bank, ICICI Bank, TCS, Infosys, Kotak Mahindra Bank, ITC, Reliance. So any such stock probably you can decide, because the movement of the stock may not be very huge. It may not move violently because of any big news in the market. So you have to select a stock like this. So the stock size should be the contract size of the future and options contract size. So the stock should be traded in future and options. So more than 100 stocks are traded in future and options category. But you select one of the top 10 stocks in the Nifty for this big buy covered call option trade. So the assumption that I have, and what I am going to show in the presentation is the Kotak Mahindra Bank. So my example also may be in line with Kotak Mahindra stock. So I have assumed a stock which is trading around between 1700 to 1800. So I bought that stock in this example and retaining it actually. So we will see one by one. Part 1, now we will move on to the slide. In part 1 of the big buy covered call option strategy, cash trade of a stock, I am assuming a stock trading at 1730, and the F&O contract size of the stock is 400 quantity, that is 1 lot equal to 400. So I am trading this stock at 1730 price for quantity 400. So right side, I have a graph which shows the profit and loss statement of this stock. So if the stock trades below 1730, so whatever is the price below 1730 into 400 is my loss. And whatever the price, if the stock trades above 1730, the difference into 400 is profit for me, which is clearly shown in this table. So when the stocks trades at 1890, the profit is 64,000. When the stock trades at 1800, the profit is 28,000. So this is what clearly shown in the table. And when the stock trades below, that is when the spot price of the stock is 1700, the loss is 12,000. So this is very clear, I believe. There are two parts. One is the cash trade. In this slide, I explained to you about the cash trade. So I have purchased a stock which is of 400 quantity, matching the F&O contract size, and move based on the movement of the stock. What is the profit and what is the loss is shown in the graph as well as in the table. Now we will move on to the part 2. Part 2 is the second trade of our big buy covered call option strategy. In this, we will be selling a future long call option. So sell a call option, out of the money call option, for the same stock that we did the cash trade. So the spot price what we traded for the stock is 1730 in the cash trade. So for the call option, we are doing a out of the money call option sell. So we have selected a strike price of 1800. So the premium I am assuming is 20 rupees. So quantity is as per the F&O contract size, it is 400 is what I am assuming. So 20 rupees premium into 400 is 8000 is what I will receive the following day in my account from the buyer. So 8000 is what the amount that will be credited in my account. So what happens when the spot price of the stock is 1800 or below 1800? So I get a profit of around 8000, whatever is the price below 1800. But if the stock moves above 1800, till 1820 there is a no problem. At 1820, so there is no profit and no loss because the premium received is 20 rupees. But above 1820, my loss increases depending upon the price of the stock. Actually, when the stock increases violently, then I incur a huge loss. That is what I had shown here. So when the stock is at 1820, I incur a loss of about 28,000. But if the stock violently moves to no to 2500 or 3000, my loss is also very huge. So here I am trying to get a profit of around 8000 by selling a call option at the strike price of 1800. But if the stock moves violently, then I will be incurring a huge loss of 50,000 or 60,000. So for to overcome this loss, this is where the big buy call option comes into play. So the next is like we will be combining both the part 1 and part 2, the cash trade as well as the future long selling the call option trade, and see how this is profitable for me, how this the call loss that I may incur because of violent move of selling the call option will be compensated by the cash trade, is what we will be seeing in part 3 of part 3, or the combination of these two is what I would say. So that we will see in the next stage. Now, this is part 3. So, profit and loss for both the cash trade and for the call option is based on the movement of the spot price of the stock actually. So, here if you look at in this table, column 4, 6 and 8. So, column 4 is the profit and loss statement for the cash trade that we did, and column 6 is the profit and loss statement for the call option, and column 8 is the combined profit and loss statement for both the call option trade and as well as the cash trade. So I have a graph here. So in the next slide, I will just show the enlarged picture of this graph and explain. Let's go to the next slide. Now moving on to the larger picture. So here we have the graph for the call option and for the cash trade and for the combined profit and loss statement of both the call option as well as the cash trade of the stock. The yellow line here indicates the profit and loss statement only for the call option. So if you have traded only a call option and for the stock movement, this is your profit and loss statement. So you will get profit till the stock trades till 1800, and if the stock moves above 1800, then we slowly our loss increases when the stock moves above 1820 is what we have seen in the call option trade. So that is what is given in this yellow line, profit and loss for the call option, and the red line is the profit and loss statement for the cash trade. So we purchased the stock for 1720. So if the stock trades before 1730, then it's a loss. If the stock trades above 1730, it's a profit. So which is what we have shown here in the red line. So green line is something which is the when you combine both the profit and loss statement of both the call option and the cash trade. So here if you look at when the spot price increases above 1800, we initially told there is a loss in the call option trade, and also we have seen there is a profit in the cash trade. That is, if you look at the yellow line and the red line, if you see the gap widens when the stock moves up actually. So which means we are incurring a loss in call option and we are incurring a profit in the cash trade. So that is how we compensate or we hedge the call option. So you see both yellow line and the red line widens. But if you look at the green line, so probably there is a limit in the profit, because whatever the profit that we take in the cash trade is compensated by the loss in the call option trade. So this is mainly considered because any loss in the call option has to be compensated. That is why we do a cash trade. So this is all about big buy covered call option. So, and if you look at the stock, if the stock is trading below 1730, however, we will get the profit in the call option. So you remember, we traded a call option at the strike price of 1800, and the profit we received is 8000. So if the stock trades below 1730 or below 1800, then no worries, because we don't have to square off that stock. We can still retain that stock, and we can square off the call option at the date of the expiry. There we will get a profit of around 8000, and we can retain this cash trade, and for the following month again we can sell a call option, and month on month we can keep on selling the call option if the stock trades sideways. So that is one of the main advantage of this big buy covered call option strategy. So this is something like we heard that Warren Buffett used to use this strategy, because the investment required for this is huge, because for the cash trade for F&O contract size you need minimum 6 to 8 lakhs, because any contract you take, the stock value comes to around 6 to 8 lakhs. So invest a stock for 6 to 8 lakhs, and again for the same stock you sell a call option month on month, and then you can probably get a profit of around 8,000 to 20,000 for the same stock. So this is the strategy, one of the strategy I heard Warren Buffett used to uh, utilize actually. Now I am sharing a live example. So this is my trade actually. So if you look at my trade, cash trade is Kotak Mahindra Bank. So Kotak Mahindra Bank contract size is 400. But if you look at here, I traded 500 quantity of Kotak Mahindra Bank at a price of 1750. The current market price of Kotak Mahindra Bank, that is spot price is 1830 1813. So if you look at the overall profit I am having, probably in the last 1 month is 31,140 in the cash trade. So if you look at the call option trade, I did a trade for 1850 CE, that is selling a call option strike price of 1850 for the month of April expiry, Kotak Mahindra Bank. So the average price I traded is 15 rupees, but it went up to 22 rupees and then probably dropped down actually. Now the last traded price is 10 rupees. So just there is a difference of only 5 rupees now. So the profit currently is 2000 rupees. But if Kotak Mahindra Bank did not cross 1850, then I will get this entire 15 rupees profit. So which means around 6000 probably I would say. 4,000 plus another, yeah, exactly 6,000. 6,000 is profit I will get in the call option trade. And depending upon the spot price of Kotak Mahindra, I will can retain this trade, and then probably for the May month also, I can go ahead and trade a call option. So in case if the stock price increases violently, then I need not have to worry about this call option, because the cash trade will give me the profit in case I incur a loss in this call option. But if the stock price doesn't increase and trades sideways, still I don't have any problem, because my call option I will get a profit of around 6,000 to 16,000 depending upon the price that I am selling for this call option for the next month actually. So in Kotak Mahindra Bank, average I used to trade around 8,000 to 10,000 as a profit monthly. I used to trade using this big buy covered call option trade. So just this live example, probably it will be easy for anyone to understand. That's why I shared this live example. So in this, I did a cash trade of Kotak Mahindra Bank for 1750, and also a call option trade selling a call option for 1850. So in right now, both the trades are in profit. In case if Kotak Mahindra Bank trades 2000 tomorrow, still no problem. My profit will be limited. So there will be a loss in selling the call option, which will be compensated in Kotak Mahindra Bank. If Kotak Mahindra Bank trades as it is, I can either square off both, or I can retain the cash trade and square of the call option at a profit of 6,000, and then again trade call option for May at a strike price depending upon the spot price of the Kotak Mahindra Bank. With multiple slides, I explained the big buy covered call option strategy and also shared a live example. So mainly this is for learning purpose, and when you select the stock you have to be very careful in case if you are planning to trade. Just analyze very well, so it's your own decision, and you also discuss with your financial consultant before trading any options, because options trading are very risky. This will help you to probably hedge your option trade to some extent. This is all about big buy covered call option strategy. If you have any queries, you please write it in the comment section. I will try to respond. Thank you very much.